2011, we were about 11% renewables. Most of that was wind. When we launched the fund, we were in 20 to 25% renewable in the UK. I'm very confident within 5 years, we're going to be at about 70% renewables. One of the key things about electricity is you cannot just go, whoops, I provided too much power there. The need to balance things in real time and the intermittency created by renewables are at odds with each other. And that's where the magic glue of batteries and more generic energy storage comes in to the picture. There is the negative impact of the creation of these sites. The silver lining is that they're dramatically less impactful than what we're doing right now. Lithium batteries are being used more for electric vehicles. The stationary energy storage market benefits hugely from the volume demand created by the EV market. Nuclear can be part of the answer because there are no carbon emissions. And the unfortunate reality is that extracting the fuel is also very, very mining intensive of the uranium or thorium in the ground.
Today, the name of my guest is Guest. Ben Guest.
Yes.
Thanks for coming on the show with me today, Ben. I know you attended boarding school in North Yorkshire in the 80s, Imperial College to be exact, known as the Catholic Eton, probably by people who didn't go to Eton. But did you grow up in Yorkshire?
No. I've got parents who grew up in different parts of the world, Argentine mother, father who grew up in Africa. So they pursued the adult, well, they were, my mother was the daughter of a diplomat, and my father grew up in Africa and pursued a diplomatic career. And my parents met in Japan on my father's first diplomatic posting, and they continued then many trips around the world. So for some educational stability, I was sent to a boarding school at the age of 10. So, well, we always had a base in London, but we were always in different parts of the world. So I spent 10 years in France, in Paris, approaching 5 years in Japan, in a later posting that my father was given, and then in Sweden as well. And then in my adult career, I've lived in New York for a short period as well.
Ah, that's brilliant. So that's quite an international upbringing then.
It's about as international as it gets. I mean, of course, there's always someone who's more international, but yeah.
How did you end up at Ampleworth?
That was the educational sort of choice. So obviously it was my parents' decision, and my mother was Catholic, and so I spent my time. I was brought up as a Catholic, and the decision was taken to send me there. It was a great school.
How was it in Yorkshire? Beautiful?
Cold. I wasn't used to it. Cold and dark in the winter months, but very, very interesting. Yeah.
If I'm correct, Ampleworth's on the grounds of a Benedictine monastery, where some of the Harry Potter films were shot.
No, they weren't shot there, as far as I know. They were shot somewhere else, and I forget where it was, but they were not shot there. Although you'd be forgiven for thinking that, because there are buildings that look similar, sort of if you squint.
So you didn't learn to fly or anything?
No, I forgot the name of the sport that you were wearing a broom, but no, none of that.
Now, while you were there, you studied electronics for your A-levels.
I did, as it happens.
Why?
I've always been interested in simple terms, how things are made, and in making things, inventing things, creating things. In a young brain, I thought of myself as a potential inventor. Really, that was really thinking as a potential engineer. And so that's not what I pursued as a career, but I found myself interested in investment in areas that are emerging, and found myself able to evaluate what the key directions of travel are for different technologies by understanding what they're made of and what the potential cost curve is and the functionality and competing ideas and so on. So I chose electronics, and probably the one school where that sort of thing isn't really studied or seen as very popular, being the kind of school it was, things like history and English and geography and the classics, which I did study for quite a long time. By classics, I mean classical languages, Latin and Greek, were much more popular. So I was one of a class of 3 doing electronics at A-level, alongside maths and physics, which were a little bit more popular.
Did you finish at the top of your class?
Well, I did an A level, and you don't get ranks relative to your peers. But I think I was the only one to get an A, but I could be wrong.
There you go. We're off to London, went to Imperial College, and there you went into engineering, correct?
Mechanical engineering, yeah.
And then what was the idea to follow that at that point?
Yeah, I mean, obviously, I spent 8 years up in the middle of nowhere, and sort of wondering what I did want to do with my life. And unlike some people, while I didn't know what I wanted to do, sort of in terms of applying myself, I didn't really know what I wanted to do for a career. So I studied what made sense in terms of where my interests were, and studied engineering. It gave me the most options thereafter, and so on. And I found it very interesting. It's an odd university to the extent that it's, I guess, the most international of any in the UK. My class, I think, had about 5% English people, and everyone else came in from abroad, making it a fairly odd place at the outset because you've got sort of various different nationalities and cliques, sort of, whether they're from parts of Asia or parts of Europe, or less so from the States, because there's lots of universities in the States that offer engineering courses, but a lot coming from the Far East and from other parts of Europe.
Well, certainly it sounds like a perfect environment for you with your background, being raised internationally. And then around 1994, you graduated as a mechanical engineer, but then started at Lazard Asset Management.
I did.
And which, of course, is not obvious. That's a jump from mechanical engineering into finance. So did you have always the idea of finance somehow to get into that, or was that serendipity or what?
Well, one of the comments made to me early on was, the passing comment was 50% of my class, and generally 50% of all graduates from some of the more, for many of the different subject courses, graduated and went into what was called the City, and still is called the City, which is basically into finance, whether that's accounting or fund management or banking and so on. So it was popular to do this, to get your grounding in, and actually it's very popular in England. It remains so, I think, to generally study, to train the brain, not to do vocational studies, although engineering is about as vocational as you can get, but other than things like education maybe, and maybe finance degrees and so on nowadays, which were not so common in those days. So that perspective was very live, as a context. So you didn't need to go into engineering. Furthermore, at that time, I think there are more opportunities now in terms of new areas of, call it engineering, or maths or logic-based industries, computing, even AI, software, and so on nowadays. In those days, we had a fairly declining engineering base, whether it was areas like steel or automotive and so on. And frankly, I found it a little bit uninspiring and depressing. The only area that would have been a really exciting career path, if I was into that, would have been the oil and gas industry, probably. But from the get-go, my background, which I haven't mentioned this aspect, is being pretty green and aware of some of the challenges created by emissions, high levels of population, and so on.
So you were aware of this already back in the 90s?
From a young. Yeah.
As part of that from your upbringing, did your parents have a particular interest in that?
It's a really good question. No, it's not. It's not nurture. It's in my nature to be interested in nature. I always was. I don't know why, but it's very much a key part of my makeup.
So you entered Lazard as what, an analyst, or what were you doing then?
So it was called Lazard Investors at the time. So Lazard Investors was a part of the London Lazard partnership. So it stood independent from the different Lazard partnerships elsewhere in the world at that time. And when the world was smaller, when communications were less good, the degree of overlap and competition between similar divisions of a business with divisions elsewhere in the world, whether it's New York or Australia or Paris even, there were few issues, and they could all sort of apply their trade. Increasingly, at the time I was arriving, the internet was, email was emerging. The internet hadn't really. And it was obviously obvious to the senior partners at Lazard, who were, especially at the very top of the family-owned aspect of the business, that there was competition was building between different parts of Lazard, or Lazard, as it was called or Lazare in Paris. And they were aware that they needed to really merge the different functions in different parts of the world. So It became Lazard Brothers Asset Management in readiness to become Lazard Asset Management when it merged with the New York business and the Sydney-based business. And that was really interesting springboard because it really allowed me to go from joining a very parochial fund management business with about £15 billion under management to being part of or maybe $1 billion even, a global fund management business, within a year or two of me joining. And I found myself in New York for a year from 97 to 98. And my eyes were opened in many ways, despite having spent a lot of time in different countries. I'd never really spent much time in the States, let alone the major metropolises of the country. So, and especially in the working environment. So I grabbed that opportunity.
Right. And so you were there about 9 years, started as an analyst, but eventually you ended up being a portfolio manager, correct?
Yes. So sorry, you asked me, did I start out as an analyst? I started out as a junior fund manager. And so that's why I gave you the background, because that was the expression for being an analyst, really, or a person who does research. But it was very much at a national level. So like being a French and Spanish speaker, I covered France and Spain, and eventually took on Scandinavia. When it became a global business, it became very much the US model and sector focused. And it became very quickly obvious that I understood engineering and industrials. So industrials was where I focused, and an emerging subset of that was the tech sector, which was not broken out of the MSCI Global Index in those days. There was no MSCI IT sector, or I can't remember. There was a telecom sector, I think, but there was no, because there's a service business, the utility business. But there were, all industrials were grouped, whether you're a sort of a company that made gears or a company that made telecom equipment, it would be in the same bucket. And so eventually that bifurcation happened, and I found myself looking at tech more and more.
How big was the portfolio that you were managing by the end of your time at Lazard?
I wasn't specifically managing a portfolio in the early years. Eventually, in the early part of the year 2000, having run a model portfolio, I was given the opportunity to run. I was on a portfolio team, but I wasn't the lead portfolio manager or anything until that time. I was responsible for leading the research on tech with a small team globally, and I was given the opportunity, having asked for it, to invest in tech long short. And so the long short division was created by a chap called William von Nuffling, who's still, as far as I know, in business, although I think running long only money only. I ran a model portfolio, sort of testing risk parameters and so on, and then launched a long-short equity portfolio focused initially on European tech and then global tech in late 2000. So by then the NASDAQ bubble had popped, and then spent the next 18 months or so basically shorting a lot of very highly valued, poor quality companies.
Interesting times. We've all lived through that. And then in 2003, you moved to Cantillon Capital. I think actually the company was being formed by an ex-Lazard team.
This is actually the individual I mentioned. William was the individual who led the founding of that business.
You ended up actually running the fund, right?
It's a tech fund, right? So there were several funds in the business: a global fund, a European fund, a US fund, and I ran a global tech fund, which grew to about $1 billion, just over.
So all of this was what one might call traditional finance. There was nothing sustainability there, right? It was just hard finance, absolute returns.
With the interesting angle that I was myself investing in newer industries as a rule, which is quite interesting. Just as a segue, I came from Lazard as a background, which is what an American would call a value shop. And making value investments or running a value rule over a tech sector is always interesting, because typically growth stocks trade at high valuations that most value investors can stomach.
And then in 2007, you struck out and founded Hazel Capital. You were the founder, managing partner, and CIO for, I guess, over 10 years. And this was just pre-financial crisis. So again, interesting times. Why did you decide to jump from one of the leading UK hedge funds at a time when they were making good money?
I'd made a lot of money, and the balance between making more money for the sake of making money, because you're absolutely right. When you're running a hedge fund, you're not creating anything. You're not creating value. You're moving value around. And this is a very blunt point. And I don't upset too many listeners by saying that, but it's a simple reality that you are trying to make money, and typically, especially in the hedge fund world, at the expense of others. So I was feeling detached from the real world, and felt the need and the ambition to do something real, and was feeling increasingly, and had been for some time when I'd already been a hedge fund manager, drawn by the clean tech sector, as it was called in those days, and realizing that it was starting to grow, to burgeon. Clean tech was a small subset of what I could invest in. And I realized that the cost of wind turbines and solar panels and so on, while still very much needing government subsidies, were heading in a very interesting direction. And bearing in mind that from an investment perspective, I could have been seen as an expert in semiconductors, applied very much to, sort of things that benefit from Moore's law, making things smaller and more efficient from a computing perspective. There were aspects that applied also to the solar photovoltaic space, which is very much a semiconductor industry, and saw an enormous reduction in the cost of solar panels, which has then subsequently collapsed, a further 95+%, having already fallen 90% then. So we're really shrinking, and seeing the volume versus price or cost trade-off as you get more volume of demand. So I felt that it was about the right time to jump, and the timing couldn't have been worse, which is a great baptism of fire in terms of launching things. Because, of course, at the start of the great financial crisis or recession, it was the expectation that all support for clean tech would disappear. And in many countries it did, and in many times, in a few countries, it even became retrospective. So even if you had subsidies, they tried to take them away from those who already had them, rather than just not refreshing them. And it has been thus ever since, actually. Every country that has felt itself over-subsidizing a sector very, very quickly tries to correct its course of action. We grew to call the solar sector the solar coaster, because it was exactly that, And the Hazel Capital, we started out with focusing on very much the way I'd invested it so far. So a long only and a long short fund, and a small VC initiative, a venture capital initiative with a partner I had at the time, while also being very interested in infrastructure. I was really aware that I worked really hard in a very odd way, frankly, to me today, to eke out double-digit return, which I managed to do every single, on a compounding basis. I had a good track record as a hedge fund manager, but every single day you have to make sure that you're on track to generate that return. And investors are much more short-term than your own investment horizon, which is a good thing to keep you focused, although it is a little bit odd. So investors very much focus on monthly and quarterly performance, when really the whole year mattered most. But it was a good discipline to have that pressure. But it was odd. Well, I realized that infrastructure investment, if you got it right, and appreciating that there's very little upside in infrastructure, and appreciate there's lots and lots of downside if you get it wrong, because you're building something, and if it's not fit for purpose or the market moves away from you, you're sitting duck. And then if it's long-term subsidized, especially in terms of the earlier projects, then you've got the opportunity to generate returns from assets that are sitting in the ground, that are real. You can look at them and touch them. They've got resale values, even if it's less liquid than shares. It was very attractive to me. So I wanted to move into that area, and I did, by making some small initial investments with prop capital, sort of my own capital, into markets that had already evolved in the renewable space. So making investments in Spain in particular.
Hazel started out primarily in solar, right?
That's right.
But then I think you started to invest in energy storage even in 2008, but then got more serious about it in 2015 when you teamed up with Norker. Can maybe tell me about that transition? And
the investments we made in storage in 2008, and then gradually over a couple of years, were in the venture capital part of the business. So it was very, very different to what we ended up doing from an infrastructure perspective from 2015 onwards. But it gave us a great grounding to understand what batteries do. What is a good battery? What's a bad battery? What are the different features of the battery? What are they made of? Where do those minerals and materials come from? And what does the manufacturing look like? And so on. So yeah, we invested in a business trying to create an alternative battery space in lithium sulfur, which I think remained a really interesting space. While most of the market was a combination of lead acid, primarily used in vehicles, nickel cadmium batteries and nickel metal hydride for all sorts of different applications, including AA and AAA batteries and all types of domestic batteries. And then increasingly lithium batteries, lithium cobalt, used in laptops, phones as they were emerging, and so on. So this was all very early stage in those days. But you had button batteries, which were very popular in digital watches and handheld devices, where they were typically sort of Donkey Kong kind of game machines and so on. So this was a different application, really targeting the transportation market because of the energy density, which is one of the key features of a battery. So just to conclude, venture capital was the investment initially in batteries. Knowing that electric cars were coming along, we made a small investment in an EV company that didn't make it. And then we were a very different animal by the time it got to 2015. We pivoted and focused entirely on infrastructure, invested in lots and lots of different solar projects, helping develop them and build them out and commission them and run them for investors through both a fund and project by project. And then I decided to focus on energy storage as it was emerging as well.
Right. So that was the big shift in around 2015 at that point.
2015 onwards, yes.
Yeah. And then I guess only a couple of years later, Hazel was acquired by Gresham House.
That's right.
And that, I guess, provided the seed assets for the then new 100 million quid energy storage fund.
So the seed assets for the energy storage fund were actually created within Hazel Capital in terms of assembling the project rights and starting their construction and funding their construction initially. But Gresham House also provided some of the incremental capital needed to take things to a full conclusion, and both through mainly through a fund, an infrastructure fund that still remains, and it remains a shareholder in the energy storage fund as well. And I might switch to calling the energy storage fund GRID because that's the ticker. And absolutely. So we've started to work increasingly closely with Gresham House. We got the seed portfolio that worked as the seed portfolio for GRID, for the energy storage fund, in November of 2018. So that was the transition.
So that brings us to the whole reason why we're speaking today, because it seems to me that you hold the holy grail of the whole renewable energy puzzle, because when I hear critics talk about renewables, it's that solar and wind is great when there's sun and wind, and not great at night. Honestly, I don't hear a lot of people talking about energy storage very much. So I want to get into all that. I guess you call that stationary infrastructure energy storage. But first, can you just give me a high-level introduction to Gresham House? Because I think Gresham House itself is more than what you're specifically responsible for. We're going to focus on what you're doing and also whatever happened with Searchlight Capital Partners in December.
That was the conclusion of a transaction that was launched in the summertime and concluded following regulatory approvals and so on. And I come on to that. So Gresham House is a fund management business focused on, alternative investment strategies. So we don't happen to have some of the more traditional alternative areas like hedge funds. And we've very much focused over the last few years. And Gresham House was a small business when I joined it. It's a much bigger business. We're running in the region of £8.5 billion today. We've focused very much on areas of sustainability. So I'm not using the words ESG. I'm not using other expressions. It's very much I think it fits the bill as a sustainable areas of investment. And in particular, the largest areas are forestry, over a third of our assets under management. And we're the largest investor in commercial forestry in the UK and Ireland, where, especially in terms of non-state-owned or church-owned forests. And then also investing increasingly in other areas abroad, in particular Australia and New Zealand. So that's a really interesting business for all sorts of different reasons. Obviously, it's natural capital. It's a material that's likely to see its use increase very significantly as it becomes a better and better engineered material. We can go on to that separately. The new energy business is running, which I'm the managing director of, manages in the region of £1.4 billion. We've got a sustainable infrastructure business running somewhere just south of £1 billion of capital. And that run, we've got two products there with the same name with different vintages, essentially, which is the British Strategic Investment Fund, and it's renamed to being the Sustainable Infrastructure Fund. So, and that invests in all sorts of different areas, including the initial investment that we made into Grid, the fund I run, as well as areas like waste, digital infrastructure, and also social infrastructure as well. So areas like nurseries and other areas sort of like assisted living. So very interesting business, as well as having what we call a habitat bank. Increasingly, laws are coming into place to require net gains from a biodiversity perspective when there's a development. So if you're going to go and ruin a little bit of of the landscape, including the projects that we have to do to green the electricity infrastructure, there has to be a net gain now. It's law. The Environment Act required this, and you basically have to go and replace what you've got. And the Environment Bank allows you to just pay and get that done by someone else extremely efficiently and knowledgeably, rather than having to do it yourself. So that's a really interesting area of growth for all of the sustainable infrastructure is a very interesting area of growth, as is the area I run. And then in addition to that, we have a housing or real estate business focused on mostly residential housing. And that's a combination of social housing and retirement housing, amongst other things. And then last but not least, very interesting area in terms of a UK investment area, both public and private, that operated very much with a private equity mentality, to the extent that we're trying to influence and support businesses of all kinds to grow. And it's not quite the traditional measure of sustainable or alternative investments, but it's a unique way of investing. We've got a fantastic track record in that area.
In my research, I came across something. Gresham House has been around since 1857.
So it's a business that was established. So I think companies have, I forget how many digits now, 6 or 7 numbers, digits in their company number. This business, Gresham House, only has 3. It's such a young business. Of course, the zeros in front of all the other numbers now. So it is a very old business and one of the oldest businesses, but it's obviously a business that has changed many times. And the business that you would have recognized a little over 10 years ago, or even 10 years ago, would have been publicly listed FTSE main board. It wasn't on the FTSE because investment trusts are not on the FTSE, but it was on the main board. It was on the London Stock Exchange. Real estate investment trust that was basically going into runoff. But the Gresham name, from street names to lots of other institutions, from educational sort of schools and so on, and other, the Gresham name is very well known, going back to the Gresham family and so on. So, and it's very associated with, it's got a very good brand reputation and so on. So it was thought of by our CEO Tony Dalwood and Rupert Robinson, who'd known each other for at least 20 years, I think, before the date that they decided to together establish the business that we're talking about. Approached, had various options and thoughts about how they should incorporate the business, and the opportunity to reset Gresham House as a fund management business. Use the assets on the balance sheet to raise additional capital from new shareholders who would back with both Tony and Rupert, and then make initial acquisitions, including Hazel Capital in due course, but the first acquisition was in the forestry space. That's how the business initially evolved. So, the initial board was approached, then the board was changed, the company was taken off the main board, it was moved onto the AIM, given a name listing, and the rest is history. Lots of growth either by acquisition and organically. And
then what was the essence of the Searchlight Capital Partners transaction?
So Searchlight Capital, and I'm speaking for them, so I hope I don't say anything that is inaccurate, are experts in financial services and identified in Gresham House, various different things, I think. Significant expertise in key areas that are growing, and are likely to grow very significantly. A significant amount of expertise in the private equity and or understanding how businesses work, and that's Tony's background in particular, and understanding what makes a good business good and what keeps it, growing and evolving well, and what it needs to have all the different functions and capabilities to achieve those growth ambitions. And also in the same vein, a very strong ability to do good deals from an acquisition perspective. So they're buying a business which has a lot of serious business acumen at the top, and while also having a lot of vertical expertise, if one can call it that, at the divisional level. and verticals of divisions which are expected and are certainly going to grow very significantly over a very long period and going to continue to attract assets, capital to invest in assets of whatever type. And so they're essentially, to wrap it up, they're buying a higher growth asset management business.
If I understand correctly, it's no longer listed. They've taken it private, correct? Yeah.
It's not private.
Is there any idea to make some restructurings that are difficult to do when you're listed?
No, that's actually a key message here, is that there are obviously opportunities to save money when you're not listed because you have less cost to run the business and promote the business. You have to have less of a public face, although that's probably going to continue. One of the key messages, this is a growth business. There's no intention to rationalize here. We're too small. We're growing very fast, and if anything, we need to keep investing in the business, if I was to speak for what I can see and what I'm hearing.
Let's now drill down what you're doing. You're the head of the new energy division, but I believe you have 2 VC funds also, or do you have more funds than that? Or
no, we've within the new energy division, we've got the largest fund is the Gresham House Energy Storage Fund, GRID, which I mentioned earlier in our conversation, and that's a listed investment trust with a net asset value of in the region of £840 million. That's the bulk of our, well, I wouldn't call it the bulk because it's over 50% of the assets that we've got within the division. But in addition to that, we've got a handful of other funds investing in both renewables, co-location. And co-location is a catchphrase for the combination of batteries and more often than not solar on a single project, and sharing a single connection with the network. So co-location, and so we've got wind, solar, co-located solar and storage, and energy storage as the biggest.
But are these substantially smaller funds?
Yes. Yes, they are.
So strategically, you're investing in some infrastructure, but the main business you're managing is grid.
Correct.
Why did you launch as an investment trust, the new energy fund, as a PLC rather than a private equity fund?
I think there was just greater interest, and interest was thin. There was a lot of skepticism of batteries. We had to sort of trailblaze a lot. People questioned, hang on, batteries degrade, they don't last that long, with, speaking to the experience they have on their mobile phones and so on. Didn't fully understand the technology risk, didn't understand the technology and therefore the risk associated with it, didn't understand whether it was infrastructure, because, infrastructure is something that should be in the ground for, decades and decades. And some had the belief that the infrastructure would need replacing all the time. So is it really a sort of consumer, something in between? The reality is that batteries do last a very long time. And the bigger you make them relative to the connection that you have, the longer they last as well, because you're using them more gently. I can come on to that. So they do have very long life from a project perspective. And I spent a lot of time in the listed equity markets myself on the other side of the table, and felt that I could speak to that investor base well. So I just felt that it was probably the area where investors could get most comfortable.
And for listeners who are unfamiliar with this structure, can you just explain what investment trust structure is?
An investment trust is a vehicle that can then invest in whatever its investment policy allows it to. So you've got investment trusts. The 2 biggest areas of investment trust anywhere in the world, frankly, but in the UK as well, are in real estate, REITs, real estate investment trusts, and investment trusts that just simply invest in stock portfolios. Those are the 2 largest areas. And of course, those real estate areas cover, residential housing, commercial housing, medical associated housing, warehousing, all sorts of different specialties. And there are several investment trusts in the UK. It's become a popular way to raise funds. And actually, it's an important point to raise here. Because one of the reasons why we went down the investment trust route is because there are already lots of renewable focused investment trusts in the UK. So, the most famous one is called Greencoat. The largest and most famous is Greencoat, with a market cap of, I think, in the region of 3.5 to 4, but it might be upwards of 4 now, billion pounds. It's a very big business. And there are lots of others that also invest in solar. And so all we were doing is launching another investment trust in this space with renewable energy sort of in its core theme, but very much being the other side of the coin from an investment perspective, in that we were absorbing the excess generation from renewables and releasing the power when they weren't generating, dealing with their intermittency created by these generation portfolios.
Right. So these shares are listed then?
They're listed.
And so it's a completely open fund with immediate liquidity.
Absolutely.
Yeah. And you said the AUM is somewhere 800 a million?
The NAV is somewhere in the region of £840 million. The market cap today is in the region of £600 million. So it's trading at a significant discount to its NAV today.
Why is that?
Lots of different reasons. The entire investment trust sector, I think there might be one or two exceptions, but I can't think of any right now, trades at a discount to NAV today. So what's happened over the last couple of years are two things at a macro level. Very simply, interest rates have gone up. That's the main thing. And then that naturally means that the cost of capital goes up in the investor's eye. But very specifically in the investment trust sector in the UK, in a world of zero interest rates for many, many years, yield seekers basically turn to the investment trust space. And so the double whammy here is that not only were people going, okay, well, the valuation of these investment trusts needs to come down because in my mind, the discount rate's gone up. They actually left in hordes because attractive opportunities simply existed in areas that they were more traditionally wanted to invest for lower levels of risk yield. And so we've had a interesting dynamic in the investment trust sector in the UK over the last couple of years. I'm very confident that we're in a cycle, that this will come back. Investors are attracted and will be and continue to be attracted in these yielding assets. So one of the key aspects, the two or three aspects of investment trusts that I can share with you are they have a favorable tax status. So income generated from within the portfolio can be paid straight through to the investor base and received untaxed. So there's no corporation tax at the top co, if you will, at the listed vehicle level. But you cannot, and 85% of all income that is passed to the top level has to be passed through to investors. It's intended to be a yielding vehicle. And then you are not able, so that you don't dilute existing investors, to raise funds when you're trading below the NAV. And that's a theme and a reality in investment trusts, I think, everywhere in the world, at least all the major markets.
Your targeted returns are what?
Our target returns are in excess of 10%.
I think the last 2 years you were in healthy double digits.
Yeah, absolutely. It depends what you're looking at. The NAV, the total return from an NAV perspective has been extremely healthy. Unfortunately, the share price rolling over has taken down the return. But yes, absolutely. Despite that, we're in pretty healthy territory.
Can you just give an introduction to battery storage and the need for battery infrastructure that's really driving or the core of your whole strategy?
Yeah, absolutely. So I'll never forget in 2008, 2010, people telling me that, the renewables sector is really interesting and everyone wants to decarbonize, of course, but the market won't be able to absorb all the intermittency. When penetration of renewables gets above, different numbers were quoted, 10%, 15%, and so on. And slowly but surely, of course, the levels of penetration rose. And, in 2011, you were at about 11% as it happens. When you got to 2015, you were up to 20% and up and up and up it went. And then, of course, the need became really obvious once you did get to those higher levels, even though it was still quite low overall, that the intermittency was starting to make balancing of the system. And electricity, one of the key things about electricity is that supply and demand has to be balanced in all timeframes, in real time. You cannot just go, whoops, I provided too much power there. That sends the voltage and the frequency of the electricity totally out of its needed parameters and starts taking things off the grid from both generation and devices and or breaking them. The need to balance things in real time and the intermittency created by renewables are at odds with each other. And that's where the magic glue of batteries comes in. And more generically, energy storage comes in to the picture. You simply just absorb power that's not needed at any moment in time, and you can release it when it is.
So this is true not only of renewable energy, this is true of traditionally produced energy or not?
That's true. To the extent that you've got base load, which is delivered in blocks, whether it was nuclear or coal, they're basically blocks of power and you don't vary the output. The demand would be varying. So you still have to deal with, I wouldn't call it intermittency, but fluctuations in demand. And therefore the blocks of power needed something. And that something typically was things like pump storage and smaller gas engines or peakers, as we call them, to meet the demand. So you had a baseload power, which would always be below the demand level, and then you dialed up what you needed to make up the difference. The difference with renewables is that they can generate more than you need as well as less than you need. And that's the challenge, that where you need batteries to absorb power, not just something to, dial up. You need something to take power off without ideally switching it off and losing it forever.
So your business is buying energy when there's oversupply and reselling it when there's short supply, and you're storing it. So your investments are actually into, we'll get into it, but battery farms or whatever, and you're storing energy and then you're reselling and effectively trading, I suppose. Huh?
Absolutely right. We're trading power.
Are you doing this only with renewable energy, or you don't care where it comes from?
We have no choice. We connect to the network. Well, we could have a choice and decide to only connect to renewables projects. That would make our business very odd and very limited. We really have to connect to the national network. And so we need to store power that comes from the entire network. And so it'll be the electrons that we're taking off the network will be from the average renewable, so overall generation mix that it prevails at that time. What is interesting, though, is that when you tend to absorb power, the power price is low, which tends to be a function of there being too much renewable generation. And so it is skewed to absorbing renewable generation, and then you release it. But the more important point is that this is being installed so that we can then, when we get to 80% renewables, actually have a way of balancing it. You can't start investing in batteries when you're 100% renewables. You need a journey there. You need to deal with the intermittency as you get there. So we have to absorb the power that is there to unlock the investment in renewables from current levels to much higher levels.
It's not a sustainability play per se, but you're providing a key piece of infrastructure that is very conducive to enabling a transition towards alternative forms of energy production.
There are all sorts of definitions for sustainability. I would call this sustainability. I wouldn't call it natural capital. We're not Article 9 under SFDR. We're not investing in trees and landscape and things like this, which are natural capital, which I think is really the toughest bar in terms of achieving Article 9, because we're actually putting things in the ground, and you can then say that we have to buy product that used materials that were mined, and that's the simple reality of what we're doing. But we are unlocking the collapse in carbon emissions, and that allows the world to sustain itself.
And you're investing primarily in these, do you call them battery farms?
Solar tends to be called a solar farm, but we don't call them solar. We call them battery projects or energy storage projects.
Battery projects, right?
Yeah, some people call them battery energy storage systems.
These are something like, 30 million quid batteries. We're not talking about batteries like you put in your TV remote controller.
No,
right?
very, very different.
Yeah. How big are these things physically, like size-wise, just to paint a picture in the mind here?
A relatively large project based on what's getting built these days is anywhere up to in the region of 5 acres of ground covered with, not densely covered, you've got to space the containers, but covered with containers filled with batteries. And those batteries obviously operated, not obviously, not many, but operated at direct current. And while the network operates at alternating current, you'll be familiar, with AC power. And so you need other pieces of equipment to make sure that the batteries and the grid can convert the power that's stored on site into the power that's needed for the network. And what you need for power for the network is to take it to AC power and then take it up to the voltage that the network that you're connecting to is operating at. And that can be 33,000 volts, while the network on the site might be 1,000 or 1,500 volts. So you need other infrastructure on site to make it all possible.
So you have these containers that are filled with batteries. Like, what's the size of a battery?
The individual battery cells, as they're called, are called pouch cells, about the size of a large mobile phone today, in both shape and size.
And where are most of these batteries made?
Today, they're still mostly made in China, but manufacturing facilities are being established all over the world right now. Mostly, and this is an important sidebar, is that lithium batteries are being used more for electric vehicles than for stationary purposes today. So the stationary energy storage market benefits hugely from the volume demand created by the EV market, even though the manufacturing lines are configured differently to meet the specifications for the cells that we need versus those that go into electric cars. But they're very similar devices otherwise.
So if I understand right, you build these giant battery storage plants. They sit next to, do they physically sit next to the grid or?
Yeah. On our website and our reports, we show you have substations all over the country. These substations are basically nodes where the electricity can change direction, essentially, and or be taken off the high voltage grid to then sort of siphon off into population centers and or industrial bases. And we connect oftentimes at these substations. You don't have to. You can connect onto cables as well, but typically into substations. And you try and position yourself as close to that substation as possible so that your cable route, the cable that runs between your own project and the substation in question is as short as possible. It just makes life easier.
You plug these in and they're used when the grid needs spare capacity. And so they're a fallback mechanism, essentially. Is that correct?
Except they're used all the time.
All the time.
All the time. Many, many times a day, if not continuously, depending on the service we're providing.
It sounds simple, and I understand that's not really the full picture, and I say that I understand that because I've heard you say it's simple to explain but complicated to solve in another interview you did. So what are the complications associated with your business?
Complications both in terms of the revenue model, in terms of, how does the marketplace contract with batteries? And there are complexities associated with building projects, huge complexities, building and designing, and then also operating at a physical level. So starting with the revenue side, let's call them imbalances that are created by fluctuations in both supply and demand in real time. And if you imagine, the wind changes direction ever so slightly, the amount of power going onto the grid may rise or reduce very significantly when you've got approaching 30 gigawatts of installed wind power. That's our entire demand. Right now, well, it's actually near 40 to 45 right now in these colder months. But the installed capacity of wind is very, very high, but operates typically at a capacity factor which is below 50%. So it's not often expected to generate all of it all the time. But we have a record export of over 20 gigawatts now on a live basis. But sometimes it can be very close to zero, and it's fluctuating all over the place. So the impact of that is that it makes causes imbalances in very short order, which are very difficult to trade away, and so but do impact something called the frequency of the electricity. So the power is meant to be at 60 hertz in this country, 50 hertz in the US at 60 hertz, if I've got that right. And the National Grid themselves have to make sure, as the entity that's tasked with making sure that supply and demand balance, have to ensure that they have the technologies at their disposal to make sure the balance is so good that even the frequency doesn't move much. So we get contracted to provide those services without actually trading power. We're actually paid a service fee or an availability fee, effectively, for delivering that service. And trading is a derivative of that we have to factor in on our side. National Grid don't get involved in that. But at another level, we can also trade actively our battery to take advantage of power price fluctuations, which are a function of the supply-demand function, the larger supply-demand fluctuations. So there's two levels. There's real-time with frequency response, and there's larger blocks that are not real-time, not second by second. There's more half-hourly by half-hour, which we take part in, and is very much a more commercially driven business. So those are some of the complexities around the revenue level. At a technical level, you've got a stack of different technologies from civil works to batteries, which then have to be wired up to each other because, I mentioned a cell is, south of 500 grams, half a kilo. But we've got thousands of these spread across many, many different containers. And each of these cells has something called a battery management system on it, a very, very small chip monitoring its voltage, its temperature, and a couple of other things. And essentially, they have to be monitored, and then they have to be monitored as subsets together And so you sort of cells are then combined into what we call modules, which are then combined into racks, which are then combined into containers. And so there's a lot of granularity that builds up. And then, of course, you need IT networks or fiber optic networks around these sites to let that information flow so that they can be operated actively. So a lot of complexity.
So you have a huge operational aspect. This just isn't investing and then it runs. So you have a couple different revenue streams.
Actually, three core revenue streams. I mentioned two of them, frequency response and essentially trading in different ways. And the third one is something called a capacity market contract, which only expects you to do anything very, very rarely when there's something called a stress event, which is essentially, it's never happened since the beginning of capacity market contracts in 2015. And no assets ever been called under a capacity market contract that I know of. And essentially, it becomes a mechanism through which the powers that be, combination of Ofgem, our regulator, national grid, the government, and so on, ensure that there's an extra incentive for the installation of the necessary capacity that's anticipated to be needed to compensate for either growing demand or the retiring of old power, and therefore we need a replacement to show up. And in the case of batteries, it's really to show up also to support renewable infrastructure.
So could you walk me through a good example of a project you feel that really demonstrates your strategy kind of from the beginning? Like, how do you select an investment? What do you have a pipeline, or how you're developing these and finding the land, to construction, to installing the batteries, switching it on, hooking it up? How does it go?
Okay, you're asking quite a complex question, but I'll simplify it. And essentially, there's a stage that was called development. And in traditional English, development can actually mean the build phase. I'm not talking about the build phase here. We're talking about very much the assembling of the necessary project rights. And project rights are essentially anything that allows you to then break ground and know that you can continue the construction all the way through to commissioning without hitting any buffers like, whoops, that piece of land we're not allowed to go over, how we're going to get the cable over to the substation. That's an example of land rights that you will need. So the rights that you need are the access to the land, the necessary planning permission, as we call it in this country, but zoning effectively, and then specific permission to build the specific thing that you're looking to put on the land. Because land might have oftentimes has been agricultural land sitting around a substation, whether it's heavily used or otherwise, and we have to ask for effectively a change of use and the installation of this infrastructure. And there are various national rules that guide both local planning authorities for smaller projects and the national government in terms of the national planning framework in terms of deciding whether something deserves to be put in such a location, even if there is an impact on all sorts of different things, visual impacts or mostly visual in the case of batteries, but potential other impacts such as traffic during the construction phase. So you need to apply for that permission. You have to submit designs and construction, sort of plans and traffic management plans and so on, very much to reassure and appease, local communities and the local councils. So during, that we will mitigate, and they insist that we should mitigate the impact on the community, especially during the construction phase. So you have to assemble the project rights. Those project rights are not assembled by the fund that I run. They're acquired by the fund that I'm responsible for. They are created elsewhere by what are typically called developers. And developers are from individuals to smaller companies that literally, do the different things, contact landlords, acquire land, secure leases, and so on. And so the other item, the key item, is obviously applying and securing a grid connection offer. So this is actually one of the big topics of discussion is if you're applying if you want to build projects, if you get a grid connection offer these days, what are they going to say it's going to cost you to connect? And when will you connect? And one of the big topics of discussion, both here and in many other countries, is blimey, one of the forgotten realities or not much mentioned realities is the number of projects that will be connected to existing network infrastructure is so significant. The grid companies are, wouldn't want to say that they're overwhelmed, but they're very, very stretched. And therefore, the only way they can deal with that is by saying, we're going to connect you in 2034, or in terms of incremental connections at a particular node. And so debottlenecking that is a major imperative for policymakers at the moment and for National Grid themselves.
So you're not putting these projects together, you're evaluating a pipeline of these projects and then investing in those and funding those.
Correct. If we, in the many fund managers behave this way and do this, and it's very much within their mandate to do that. One of the ways that we like to differentiate ourselves is to actually carry out a degree of development activity within Gresham House. And the reason and rationale for that is, number one, you've got to control and oversight of a project from virtually the greenfield status, and therefore can determine whether you like it or not at an early stage and discard it or if you don't like it. You can influence the design and therefore what gets submitted for planning, so that you don't then have to resubmit, because so often you have to resubmit to planning. So even though a site has permission to build a battery project, what actually you end up building, usually it ends up being a bit different, especially as the technology is evolving and also requirements are evolving, such as fire requirements and so on, for fire safety. And so you want to mitigate that as much as possible, because each planning cycle is quite laborious, time-consuming, and a little bit costly. So that's another thing we want to make. And of course, the main advantage is visibility of your pipeline and the cost saving for the fund. So the fund has acquired projects far more cheaply they would be acquired than they would cost if they were just bought fully finished by another developer, selling it at the highest possible price to the market.
So you end up funding a project that you're investing in the project. This operator developer builds it, hooks it up and turns it on. And then who actually operates it?
So the construction process is very much overseen by ourselves. We select the construction company to build it. And increasingly, we are breaking up the different parcels of work and managing those ourselves, again, to save money. And because the margins charged by turnkey contractors are very high. So again, another way of mitigating the cost of construction is by getting involved in it. And I've been doing that for a very long time, and we have a dedicated team actually managing the construction program and running procurement and other things as well. So we're very involved even at that stage. And then once you reach what's called COD, the commercial operations date, it becomes taken over by our operations team, who basically monitor the site and monitor the operations and maintenance contractor, which is a different entity. And usually the entity that built it, but not necessarily if we built it, coordinated the construction ourselves. So the operations then is the operational team then manages the site from all sorts of perspectives. So maintaining the different contracts that you need to maintain, such as leases, grid connection contracts, and so on. The payments, the renewals of contracts, such as operations and maintenance contracts themselves. And then, of course, the appointing of the relevant trading entities that will then dispatch the batteries. And they're actually called optimizers, to optimize the revenues possible from the marketplace. So there are companies in the market today, all over the world. It's very much the same model everywhere. Very, very few battery operators today do their trading in-house. That's likely to be a trend that shifts as we gain scale. But right now, we are outsourcing the actual day-to-day trading of these batteries to optimizers that we monitor and work with through our commercial asset managers, as we call them internally, which make up a subset of our operations team.
So you're not doing the trading in-house.
We know what we want to see.
Right. Okay. So then how do you evaluate your investments? You've found this project, you've invested it, you funded it, or you you actually get quite involved in the construction. You turn it on, and then you're storing and somebody's doing the buying and selling of the energy stored there. Do you evaluate each one of these independently? How do you do that?
So a lot of infrastructure investments see their economics locked in on day one. And by day one, I really mean the final investment decision point or financial close, rather than the day on which you turn it on. You've made decisions to pay for batteries, build out a certain design, accept a certain grid connection cost, accept various ongoing charges, accept lease costs and so on, and accept a particular location for a battery. And all these different things, you have to live, most of these different things, you have to live with thereafter. You have very little potential to change a lot of those things. One thing that you can change is the duration of the battery. So if you've got a 1 hour battery, it takes an hour to charge or discharge from full to empty or empty to full. You could add more batteries to change the duration. That's something we're actually looking at because there's enough trading opportunities to run them in one direction for long enough to justify that incremental capacity. That's something we can do. But really what we're trying to optimize here is the sort of limiting the upfront cost of a project so that you've got the greatest margin of safety to hit your returns over the longer term. That's why we're so focused on development and so focused on construction, because it is the entirety of the cost of a project. Then once you're operational, the real focus of our operations team is to focus on maximizing revenues by getting the best optimizers working for us and also managing uptime. So making sure that the batteries don't go offline for any reason. And our uptime is extremely good. We're up in the very high 90s in terms of percentage terms. And the majority of the downtime is actually driven by the need for outages for the grid companies to upgrade something or to deal with storm damage or whatever else it might be.
Do you ever sell a project or not once it's constructed and after you operate it, you determine it's not giving you the return you wanted? Do you sell them?
Projects are tradable. It's quite rare for projects, whether it's in the renewable space or in the battery space, to sell projects unless their fund reaches an end of life. But this is a closed-end fund, so it doesn't reach end of life. But being an investment trust, one of the features is that there is a continuation vote every 5 years. And should the shareholder decide not to continue, the board has to look to either restructure the company or wind it up. So that happens in REITs, for example, sometimes and so on. So unless that happens, the motivation to sell, and it just so happens that we do have a sale process in train right now, is driven by any number of things. To raise capital when you can't raise any, that's one. To demonstrate that the valuation ascribed by the market relative to the NAV is too low, and therefore you try and sell your project at NAV, at NAV, and therefore show that the market's undervaluing your projects. That's also topical right now. And then from a mixed perspective, some of our earlier projects are smaller, and there are some players out there who are happy to buy smaller projects where actually, our smallest project, for example, is 5 megawatts. We've got a handful of projects below 20 megawatts, a small handful. But we're incrementally building projects of 50 to 100 megawatts. So there's a motivation to, I wouldn't call it you could call it tidy up, but essentially to rationalize and
you've only got so much mind share, and you're trying to leverage
to optimize
it,
the way you manage the portfolio. Absolutely.
Are there any impact metrics that you track? What are those, and how do you track that?
Yeah. So interestingly, there are various reports we've got to produce for auditing purposes. So we would have something called the ESG report, which is voluntarily drafted, to incorporate the net emissions of the fund, some supply chain studies, and so on. And more, this is being dictated to us, so we don't have to create our own version of that. For example, to maintain our SFDR status, which is a European standard to classify a fund, we report against a series of different questions once a year and publish that as part of our annual report or at the same time as, and refresh it if we have to, if we're drafting a prospectus, for example. There's also something called TCFD, Task Force for Climate Financial Directive, I think, something like that. And essentially most companies have to create a TCFD report now, incrementally. There are various different bars, so not all companies have to deliver these. Companies that are larger need to deliver these, but we've chosen to do so within our portfolio. Within our company, a grid that is, as well as Gresham House producing one as well. As part of that, and it used to be separate to this, we also disclose greenhouse gas emissions, on a CO2 equivalent basis. And there are different measures of this. So the direct emissions. So, for example, if you're spewing gas out and CO2 into the ether, for whatever reason, that's scope 1, and then you've got scope 2, which are more indirect, and then scope 3, which is more indirect still, including the supply chain emissions and so on, which are much harder to track. So scope 3 emissions are not reported by a lot of entities because it's very difficult to calculate, and there's a degree of subjectivity that comes in. But scope 1 and 2, we do absolutely report against. The unfortunate reality is that we do actually import some gas-fired generation, as we mentioned earlier, and then release it back in But we lose some of that because even our batteries, even as efficient as they are, will lose in the region of 10% of the power that we've stored through line losses, as we call them, heat losses in the different systems that we've got. And so we report that essentially. And that number will just naturally come down as we get more renewables in the system.
What percent are renewables in the system right now?
It's in the region of 45% today.
Is that UK wide?
Actually, GB. So you've got to focus on the land mass that is Great Britain and the network that operates within that. So that's a GB figure.
And who are your primary investors?
So we've got various different categories of investor. So you could call it institutional fund management businesses. You will know them well, the household names, down to discretionary fund managers or wealth managers. So one of the largest growing areas of fund management, asset aggregation in the UK has been amongst wealth managers who, the mass affluent market, essentially. And then, of course, you've got high net worth investors and smaller institutions as well.
You announced last year a battery storage project in California alongside NextGen, which was your first project that you've launched outside the UK and Ireland. How transferable is the system that you've developed in the UK or GB when you're looking to expand into new market? Why aren't you going everywhere?
There's a huge degree of transferability. First of all, if you know how to analyze a market, and bear in mind my background going back to the beginning of the conversation, if you know how to analyze a market, which we did initially for Great Britain and help develop it as well, you can then know where to look and how to look at a new market. And the US is a very interesting market. In particular, California is a very interesting market. It's benefiting from the Inflation Reduction Act's sort of introduction of the investment tax credit for batteries or battery projects, and especially standalone battery projects, but also co-located battery projects with solar. And that meaning that you get a significant rebate. There's also a much more contractual structure in the US, where I mentioned capacity market contracts as a layer of our revenues. There are higher levels of the more generous payments in the US than in the UK. And I think the UK should revisit the way it subsidizes or supports batteries, because I don't think it's doing the best job. So there's much more support for batteries from a fully contracted basis over there. But otherwise, batteries, and bear in mind that the electricity industry evolved around the world at the same time. And so different governments and or national grid companies shared their experiences and developed networks in very similar ways. And of course, their regulatory structures are slightly different and sometimes very different, but essentially they all rhyme with each other. They all look at frequency as the goal to maintain. They all appreciate that electricity needs to be balanced in real time. They all deal with what we call ancillary services or frequency response services to address those short-term real-time imbalances that can't be traded. They all have wholesale markets. And so there are a lot of similarities. It's just that the way they're implemented can vary. And then it's just a case of learning what that is. And so that's one category from the operational project perspective and the modeling of a project before you build it. But then the development of project rights also chimes. You need to sort of, but the rules vary. Sometimes you need a construction license. Sometimes you just need a planning permission. Sometimes you need something else. So it just varies. But you always need a grid connection offer. You need a permission to connect to the network. But again, that can be broken down in different ways. And the timings of payments can vary. But essentially, it's highly transferable because you're just rerunning the analysis with the rules that apply to the locality. The tech is the same. You install the same stuff. Are
there other competitors like you out there doing this?
We have had a competitive advantage in Great Britain. We were the first to launch. We're still the biggest in the country with approaching 25% market share. So we're still very significant in this country. Internationally, though, the markets have developed in a lagged fashion to the UK, or GB, which was the first major market, although Korea actually sort of built more earlier because it's got a large battery market, and so have the Chinese. But the US has grown very, very rapidly, and other European markets are catching up fast, like Spain, Italy, Germany, and others. So the whole world market is evolving its battery energy storage market.
So ostensibly, you could scale abroad.
We'll absolutely aim to scale internationally. Absolutely. I mean, the UK, as I like to share, is just 1.5% of the global electricity market. I don't want to miss out on all of the rest of it.
Are there any specific risks with your strategy? Is there anything specifically with you? For example, battery technology.
There's always a disruptive technology risk, but I think it's very, very low. There's always a risk that we have issues and there's changes. I think the biggest risk here right now is policy, government policy and regulation. And I never expected to say that, actually. We sort of moved on from where our share price was to the NAV. But the simple reality is that at the moment, and I say at the moment because we are trying to change this, at the moment, our major counterparty in this country, and the major counterpart we will have in other countries, is a combination of the government and National Grid. National Grid has to balance the market and therefore influences how the market behaves. They are our counterparty when bidding for frequency and when running frequency response contracts. They are our counterparty. National Grid runs the auction regime for the capacity market auctions, even though they're funded by the government. National Grid operates the traded market. And essentially, you've got a commercial market which has buyers and sellers of power, but they're not obliged to buy and sell exactly what they promised in the contract. There's allowances for variability. Otherwise, you'd be forced to turn your switches on exactly when you want to. And every wind turbine would have to generate exactly the amount it should. So batteries come in and dip into that, but there's still a residual imbalance. National Grid trades that balance away. One of the realities that we've become unfortunately aware of over the last year is that National Grid's ability to trade batteries has not been there. They haven't had the systems in place to turn on or turn off or sort of export or import power from the battery fleet simply because they didn't have the systems in place, because they were used to trading very large assets which could be instructed manually. But when you've got hundreds of batteries, which are much smaller than large gas-fired stations, you have to automate this. And that automation had not happened. So there's a counterparty risk, a policy risk, a regulatory risk that National Grid, for example, needs to action its upgrade. And there are policies in place to encourage that. But if it doesn't happen, we still got to live with that reality. The good news is that we have good relationships with National Grid. We understand their rate of innovation, that these new systems are coming along and so on. But the reality is that has thrown us a curveball over the last year and has impacted our ability to generate revenues, as an example, as a major example right now.
You said, I think, renewable energy still only represents around 40 or 45% total in Great Britain. How do you view the path to 100% renewable energy in the UK, and what will be the accompanying trends in the marketplace as we go down that path?
So I mentioned, I think earlier on, that in 2011, we were about 11% renewables, and most of that was wind. When we launched the fund, we were in 20 to 25% renewable in the UK. And in the last 5 years, we've been operating for about 5 years, just over. We've gone to double that. So it's doubled. The good news is that there's a subsidy regime called the Contract for Difference regime, which subsidizes primarily offshore wind projects. And contracts are awarded on what's called a T-4 basis. So you've got basically 4 years to build out your project. So we know what projects have T-4 contracts right now and what is likely to therefore show up over the next 3-4 years. When you look at that, I'm very confident that within 5 years, we're going to be at about 70% renewables in this country. In about 5 years. I mean, it depends on where demand goes. It depends whether everyone builds their projects or not. But yeah, absolutely. So that intermittency will only grow. And one thing I haven't said the whole time, despite the amount of time we've spoken, is that renewables, as a rule of thumb, in this country, and it will vary by country, and that's one of the other big differences by country, is that weather is very different. And all these renewables are driven by the weather. So in this country, which is quite windy, and we've got a preponderance of wind generation, is that they can generate anywhere between very close to 0 to 200% of their expected average over a quarter or 1 year period. So that gives you an idea of just the extent of the intermittency, that you can be at twice what you need or very close to 0 for an amount of time. And that amount of time might be a few minutes or it could be a few days.
Are you taking any steps to ensure a responsible supply chain in battery production? And on the environmental side, are you doing anything to mitigate detrimental environmental impact generated during production? And of course, there's this whole question about disposal on the other end of the thing.
Yeah, and recycling, yeah. So the simple, unfortunate reality, and I made it very clear, we're an Article 8 fund, not an Article 9 fund under SFDR. There is an impact, a negative impact of the creation of these sites. The silver lining is that they're dramatically less impactful than what we're doing right now. The beauty of renewable power is that you install something, and of course you have to maintain it. There are bits and bobs you have to do around the edges, but basically it's installed in place for decades, not requiring a truck, a ship, a drill to go, and every time you've burnt it, you got to go and replace it every time, right? So just think of that. There's some good graphics out there you could Google or find on LinkedIn or whatever that show. So what you're really addressing is the embedded carbon and embedded environmental impact of a site, batteries included, because they're not using a fuel. Okay, they'll have backup generators for all situations, but they're not going to be used very often, very, very rarely, in fact. So you're really talking about a solar farm or a wind farm or a battery being installed for decades. You have to go to a hillside or combination of hillsides around the world and source those materials. And unfortunately, that's the reality. There's an environmental impact. I'll come back to the labor aspect in a second. There's an environmental impact of that. But the good news is that it has a really long shelf life. And so the longer you can make that infrastructure work with no fuel use, because and to generate the renewable energy thereafter, the lower the impact, the greater the payback you get on that damage that you've caused, whether it's environmental in terms of habitat impact or whether it's embedded carbon from the creation of the steel and concrete that you've created, which increasingly will be decarbonized because even that's being electrified. If someone who doesn't put their hand up and say the reality is that there is an impact, that is wrong. There is an impact. It's just much, much smaller than forever digging coal out of a hillside, extracting methane, losing some of it, which has a horrible marginal impact on CO2, on CO2 equivalent emissions, because methane is way more greenhouse gas-like than CO2. And again, you don't have other emissions like soot and other sort of noxious fumes. So the reality is that there is an impact. It's a heck of a lot smaller than the status quo, than the fossil fuel world. And again, we have to work to try and improve on where we are now. Speaking to supply chains and labor practices, there's something called the Anti-Slavery Act in the UK, and actually it's a European level legislation as well. And companies have to declare that they are not allowing labor laws in other countries that result in the exploitation of people. It's a thorny issue because it's very hard to track, and even major companies are being caught out all the time. But there's a very, very significant focus on this, and we care about this a lot. And we've done some bespoke reports on the battery supply chain itself as the majority of the bulk of what we source. And also we're using what we call LFP batteries, lithium iron phosphate batteries today, because of the serious concerns around the cobalt in mining industry, where artisanal mining and labor is frankly rife, apparently. So we're very aware of these different topics.
I also seem to have this feeling that our accounting systems really aren't in any way able to capture all of these impacts. And that's also true on the fossil fuel side. But I'm just saying, I'm not sure we can get down to a really what you would call a good analysis of that.
You can try, and there will be an error margin. And depending on what you're trying to solve for, you can definitely get to a figure of what's the embedded carbon in a site, and then how quickly if you want to look at it in terms of carbon payback, it's a slightly dodgy approach, I think. But in terms of avoided energy consumption, fossil fuel-based energy consumption, that then sort of justifies that investment, while a gas burning site has an embedded carbon and then continues to generate carbon dioxide into the atmosphere. There's lots of things you can measure. There are certain things that are very difficult to measure unless you've got eyes everywhere, from especially monitoring of environmental impact or labor laws. But we strive to do so, and there are companies dedicated to doing this that we work with.
I've listened to Mark Andreessen speak, and he makes this statement that he feels nobody is serious about climate change because he says we already have the answer, which is nuclear power. It's generation 4, but nobody wants to talk about it. And so he says he doesn't bring it up anymore. What does Ben Guest say?
So I will say nuclear can be part of the answer, right? Because there are no carbon emissions at the point of consumption or combustion, if you will, atomic energy reactions, but you get the point. The unfortunate reality is that extracting the fuel is also very, very mining intensive. The density of the uranium or thorium in the ground is very, very low. So you have to extract huge amounts of ground before you get to the material, and you're consuming it. So it's not like lithium. You have the amount of the concentration of lithium in the ground is also quite low, but it's usually quite close to the surface, not always, but quite close to the surface, and it's higher density, and it also runs for a long time. So there's a greater negative impact, in my view, from the fuel. Then there's also a simple cost reality. The cost of building a nuclear plant, the cost of the fuel alone is higher than the electricity price that prevails in most countries. Just the fuel, not the cost of amortizing the cost of the plant. And so all these nuclear plants are heavily subsidized around the world. In France, which has the majority of its power from nuclear, it's basically absorbed by the taxpayer. And so the taxpayer effectively sees a very low electricity price, but there's a huge amount of other cost that goes into the front, paid for by the taxpayer indirectly. So it's just a much more expensive technology. And there's also a safety track record that worries a lot of people. Germany got itself straight out of nuclear within a small number of years as soon as they saw what happened in Japan. So that's a serious concern and would be a very significant concern for me as a citizen of this country because of the population density. So building things here is difficult. The government in this country has a very significant commitment to nuclear. It'll be interesting to see how much of that gets built. The simple reality is that power plants in nuclear are very, very difficult to build. They take a long time to build, are almost always over budget, and sometimes very significantly so. We're still dealing with a finite fuel. I want to move away from fuels altogether, so you don't have to extract anything from the ground. But from the perspective of energy security, there is a really strong logic to having something else in the mix, even if it costs more. So I do appreciate that it's another option.
It sounds like what you've explained today, whether it's nuclear or fossil or renewable, you're there to match supply and demand. You need what you're doing in any case.
That's true.
If you had to name the single most important challenge in the sustainable investing space, what would it be right now?
Right now, it has to be reaching consensus on what the solution is. The solution used to be very simply renewables plus flexibility, a generic term for energy storage and other things. Other things have come into the mix, like carbon capture, hydrogen, and other things, which just muddy the picture. And I do wonder, I'll let the investor work it out for themselves, or the listener. There are lots of things muddying the waters. I do think that we need to get back on track to focusing on the stuff that works and making the most of what we've got, rather than trying to think that we can invent new things as essential parts of the solution. They're not necessary.
What do you know now about sustainable investing that you wish you knew in 2007 when you founded Hazel Capital?
The degree to which you need to understand how political this sector can become, especially as it becomes more and more important.
I think I'm going to let you run. I know you have a hard stop, but I think we got to the finish line. It was really great talking to you. So I thank you very much, my friend, for taking me through all this. I really appreciate it. It was amazing. Before you jump off, tell everyone your websites and social and all that good stuff. What's the best way for people to contact you?
You can certainly look me up on LinkedIn. We've got a website, greshamhouse.com, which has a subpage that you can find for the Gresham House Energy Storage Funds with my contact details. The London Stock Exchange for regulatory update or the sort of statutory updates are all there. Same with Companies House. So all the usual places that you might look to find information and or phone numbers, you can look up that way.
Great. Ben, thanks again. Goodbye, everybody.
Thank you. Goodbye.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.